Now let's come to the next concept in technical analysis, which is moving averages. Now moving averages is a concept very commonly known to even non-technical analyst people. So they have the understanding of, at least they've heard of what a moving average is. Now why moving averages are so common or so important for that matter, even though so many people use it, they are still successful and they're still useful in technical analysis. So what is it so important and so special about them? So if you look at the moving average, so this is usually a constant period average. We take moving average for 10 days, 20 days, 60 days, 100 days, 200 days and so on. And prices are calculated, successively every day based on that chart interval. So when we plot these prices, what we get is a smooth curve. So we get a smoothened line of successive average prices. So any fluctuations, volatility is kind of dampened out. Any short-term oscillations are dampened out. And this gives us a very useful market indicator, or rather tendency, especially when we combine the moving averages. Right? You would have heard such concepts in news when short-term moving average crosses long-term moving average. And we'll see the significance of that in this chapter. It was formed as a concept not very far back. It was formed somewhere around 1990s. Rather, it was demonstrated that moving average has statistically profit-making abilities. It reduces bias. It's a statistical bias reducing method. And crossover signals from moving average, we just mentioned, we would have heard in news, they also have a statistical significance importance in terms of profit making. So the academic studies have been there since before, but their importance and significance has been proven very recently, and that is also because of some advanced computing techniques. Now these results have been validated and they are used. The important idea here of using moving averages, just the fact that we can profit from moving averages acts as a point to prove, or rather disprove, the efficient market hypothesis or random walk hypothesis. And we know how technical analysis in general is. The fact that we can make profit from technical analysis is in a way disprovement or a proof against the efficient market hypothesis. Moving average is just next step in that chain. So there are usually the moving average, the simplest of moving averages is calculated as arithmetic moving average. As the name suggests, it's the average price of last n trading days, and arithmetic average, simple average of last n trading days. N could be last 5 trading days or 200 trading days. It depends on how long period we want to take. That is the simple moving average. We also have linearly weighted moving average. Right? For example, there is a theory, there is a thought process that suggests that on a given particular price, impact of the more recent price is higher compared to price which was observed, let's say, further in history. So what we do is we give weightages to recent prices. For example, if you are taking 10-day moving averages, we could give a weightage of 10 to the recent price, weightage of 9 to the 2 days old price, weightage of 8 to the 3 days old price, and so on. And that would be averaged out as a sum of 10 plus 9 plus 8 until 1, which is 55, to arrive at a linear weighted moving average. Now whether we are taking simple moving average or linearly weighted moving average, it helps us to determine certain support and resistance levels as well. Wherever we see a shorter moving average crossing the longer moving average, it acts as a mechanical signal, especially when the shorter moving average is crossing above the longer moving average. It's a mechanical signal to buy, right? Or at least an uptrend. Similarly, there is a trend, there is a sell signal or a downward trend signal when shorter moving average declines below the longer moving average. So it acts as a trigger point or an indicator to suggest, to confirm the trend and to, in a way, enter into a position for that. So we have simple moving average, we have linearly weighted moving average, we also have something called as exponentially weighted moving average, or EWA. Again, the concept is same as the linearly weighted average, but the numbers are not, the weightages are not decreasing linearly, but rather exponentially. Now we could have weight of a particular day or weight of the recent day, as we've proposed, right? The recent price has the highest impact on the current price. The previous close price or previous trade price has the highest impact. So the weight of the last trading day could be considered as 2 divided by number of days in moving average plus 1. So for example, if you have 10 days moving average, then the weight of last close or the latest available price would be 2 divided by 10 plus 1, that's 2 by 11, approximately 18.2%. And rest of the days moving average could be considered as equally weighted. Remaining weight 100 minus 18%, approximately 81%, 81.8%, that will be distributed across remaining 9 days of prices. Again, that calculation we can always get into, but practically we don't expect these calculations to be asked in exam, nor do we ever have to do this calculation manually, because we have even the basic software tools, charting tools will have moving averages as a feature in them. So we don't need to calculate these exponential moving average. There is also called as geometric moving average, which again gives weightages according to certain geometric weighing or even triangular weighing. There are different ways of giving weights to recent prices or certain groups and ranges of prices. We have Kama or Kaufman adaptive moving averages. We have MAMA, which is usually used for commodities, but it is Mesa adaptive moving average or following adaptive moving average. Again, these are different types of moving averages which are formed by different weighing formulas, weighing strategies. We don't need to look at the formula, we can just plot them. The basic interpretation is going to be the same. Each of these variable moving averages have their own pros and cons. We don't need to get into the details of individuals. Important aspect is how do we use these moving averages for profiting? What are the strategies that we use by that we can be deduced from moving averages? First is determining trend. So first, how we look at it, the trend or the use of moving average for determining trend depends on our investor's time horizon. So if you are looking at a long-term time horizon, we'll look at something similar to 200 days moving average. But if you're looking at something short-term, couple of weeks, couple of months, then we'll look at maybe 60 days moving average. Now, how to interpret it is, if my current price is above my 200-day or 60-day moving average, that means it is an uptrend. And if I want to be a long-term contrarian investor, I will not rather invest in uptrend, especially if I'm working in long-term time horizon. I would rather buy it when a stock is in downtrend if I want to hold it for a longer term position, right? If I'm in a short term position, if I'm trying to catch the wave and get on the upper trend, then I'll invest when the prices are increasing, right? Or when there is a crossover of short term trend increasing long term trend, which is basically trend chasing strategy. Another use is to find support and resistance level. As we've seen earlier, moving average often duplicates as trend line. It's a smoothened trend line of sort. Therefore, a moving average can be used as a trend line, or it could be even used as a easy trailing stop mechanism. Now we have seen what a stop is, a stop, breakout, and retracements. So moving average could be used as a trailing stop support for our positions, right, for liquidation. Also at the same time, usually prices are consolidating, or the price start moving horizontally near moving averages, so that could also be used as an exit point, exit indicator. Next use is to determine price extremes. Now price extremes is a slightly different use and it's not used very commonly, but what we have to do is to calculate the ratio of close to 10 days short term moving average or linear moving average. So if we take a ratio of closing price of each day to the 10-day moving average of each day, then that could help us give some signals, and that could give us a price extreme. So if you plot this chart of this ratio, close to 10-day moving average price ratio, then when the ratio is near the highest, that could be my overbought zone. So usually this is the term associated with overbought and oversold terms associated with moving averages. When my prices are below my 200 day, 60 day, 50 day, 10 days moving average, I am usually considering stock in the oversold zone. Has been beaten down. Current prices are below my short term and long term moving averages. So I'm expecting the trend to reverse soon. So that's the price extreme on the lower side. On the other hand, if my current price is about 200 days, 60 days, 26 days moving averages, then I'm in the overbought zone. My prices have gone up very recently and very quickly. So I may see a consolidation. Prices may even drop down or at least stay flat for a while. So those moving averages help me to determine price extreme, and to give it a mathematical base, I can use as a ratio of close to 10-day moving average. Giving specific signals is something we have seen already. When short-term moving average crosses long-term moving average, if it goes above, if short-term is above, then we are in uptrend. If it is below, then we are in downtrend. And so let's look at some certain graphs to understand the moving averages. So let's look at these moving averages in a graph. So this is my price chart, and I can calculate multiple moving averages here. So if you look at this particular area, whenever I'm plotting moving average, it is given by parameters like this. MA is moving average. When it nothing specified, it is simple moving average or arithmetic moving average. 13 means 13 days moving average. On close basis, so I'm considering close prices, not high prices or open prices, and there is no other variation, other shift. So currently, see, when my price here, this is my latest moving average. So my price is last price is 15,300, but my 13-day moving average is 14,987, because I'm seeing it is a uptrend. Last 14 days prices, all of them have been below my current level, so it is going to be lower than my current price. If we just look at this particular chart here, my 26 days moving average, 60 days, so just follow these lines. Blue number is blue line. Now blue line here, this one, if you can notice here, if you can distinguish this between multiple lines, blue number is 13 days moving average number, so follow the blue line. Orange is 26 days moving line. This is my orange. You'll notice this is less fluctuating. There are, if you look at these ups and downs, there are high fluctuations in the daily prices, but 13 days moving average blue line is a little less fluctuating. Orange line even less fluctuating, more smoothened. Light blue or sky blue line is 60 days moving average. This is almost like a straight line, a smooth curve. I push it further. This yellow, dark yellow line, 200 days moving average, right? Look at here, 200 days moving average in yellow color. Yeah, so this yellow color line, you can see it's almost smooth. No fluctuations observed in 200 days moving average. So it dampens all the fluctuations, but it sure follows the trend. We also have 13 days exponential weightage moving average and variable weightage moving average. Again, these prices very similar, very close to current prices, but they are also very similar to 13 days simple weighted moving average, and they follow the curve, right? They follow the general ups and downs, but they are more smoothened, especially in this region. They're very smooth compared to the stock prices. If you notice these points, as we go on increasing from 13 days to 200 days, my moving average value is lower because in this region my prices have gone up quite drastically. So my current price is 15,000. My moving averages are all below them, and closer weightage in case of if you notice here, weighted moving averages where I'm giving higher weightage to recent prices, all of them are closer to my recent price than simple arithmetic moving average without weighing. So this is something you can keep in mind. Next, we will look at envelopes. Now, what are envelopes? So first we'll look at this particular graph here. We have 13 days moving average, 26 days moving average, 13 days exponential moving average. These are lines blue, orange and green. So blue, this dark blue line, hope you can see. Then we have this orange line and green. Hope you can see this green line almost tracing the blue line. Exponential weightage and simple weightage are not very different in this case. So it's almost tracing the blue line. We also have 13 days moving average. We're not looking at it. Now we also have envelopes. These two, this shaded region which we see is envelope. How to read it is, it's 13 days moving average envelope with 2 standard deviations up and 2 standard deviations down. So these blue lines are up and low or top and bottom ends of the envelope, and the black line is the average line, right? The black line is going to be tracing, it's not very visible in this chart, but we can see the top and bottom line. So this is my 13 days simple moving average plus minus 2 standard deviation. That gives me a range. It also acts as a support and resistance line or a indication. If my prices are moving above this line, it means it's in oversold zone. It's expected to drop, and whenever it is below, it is expected to come in the range again. So you'll notice the prices are slightly going outside this 2% envelope, but then this is almost like a resistance and it is dropping again in the zone. Again, slowly going outside and again dropping inside. Going outside on the lower side and then strongly coming inside. And these points can act as my stops also because they are getting adjusted. They're accommodating the changes in prices and accommodating the volatility as well. So this is my calculation of moving averages. Now we will see other points, other trading concepts related to moving averages. Okay, so now one of the biggest contributions to the concept of trends and directions is the concept of directional movements or directional movement indicators. One of the biggest or the most important directional movement indicators is the Wilder indicators or the Wilder method of calculating directional movement indicators. So what we do is we have two directional movements, DM plus or DM minus, or minus DM and plus DM, either ways. Now what plus DM or plus DM plus is, it is a positive directional movement. So it occurs when high for a day exceeds the high for the previous day. Simple. So if we have to put it here, so this is my bar chart. If my bar is like this, then I have a high for current day exceeding the high for the previous day. It's a DM plus. If on the other hand here next day my position is like this, then I could have a DM minus or minus DM, which is basically the low for the day here is less than the previous day's low here. So we will compare these 2 points and I get DM minus. If I compare these 2 points, I get DM plus. So it can very well happen that I have this one particular chart and this one particular chart. So low is lower than the previous days and high is higher than previous high. So what does it give us? In this case, whichever magnitude is higher, right? This value and this value. I'll trace this. Whichever magnitude is higher will be my trend or directional movement for the day. here we can see this particular area is higher, so I will have a plus DM or DM plus, positive directional movement. Here I have positive direction movement, I have negative direction movement. So this is my directional movement. What I use it for is basically the first use of directional movement is, when one directional movement is higher than the other, the trend is in the directional movement, right? So I can calculate a directional indicator using moving averages plus average trading range, and I can calculate the trend. So if my directional movements, if my DMs are higher, I can calculate DI, right? Directional indicators from directional movements, and the DI could give me my trend. If my DM, the value of DM, if I have a DM plus DM continuously, then my directional index could be increasing. If I have a minus DM, right, or a decreasing directional movement like this one, then I could have a negative or decreasing directional indicator, right? So I can simply join these points and I can get a directional index. We can add on average trading range, 14-day average trading range, for example, over the directional movements, and right, moving averages, directional movements plus ATR, and get directional index. Second is crossovers. We'll look at these strategies through graphs. I'm just calling them out here, and we'll understand what these movements are and see them, relate to them in our graphs. So let's go to the graph and we'll understand these concepts better. So this is my price movement. This is my directional movement indicators. Right, you can see blue, orange, red. These are three directional movement indicators. So these are my D plus, D minus, and other indicators, right? This is my directional movement index. So we can calculate this index, and we can also call it something called as ADX, or what is it called as average directional index. This is the average of DM plus and DM minus directional movement indicators, which gives us as ADX. Now, what is the significance of ADX? It's basically the smoothened value of directional indicators, and it gives us a trend line. It gives us a confirmation and also a trend line. So if you notice this part, right, in most part it is following the trend, but here, even though prices are increasing, my ADX is decreasing. Here, for example, prices are increasing, but my ADX is decreasing, rather concave. What does it mean? So it gives me a price information. So how we should look at it is, when ADX drops like this, there is a significance reversal, or vice versa. You can see here big red bar, big drop in closing price. Here big drop, bigger drops, right? Here big movement up, but it's a huge movement. Compared to the bars, here we have higher volatility. So these bars individually considered, they should be considered in their surrounding. But here, if in this area all the surrounding bars are very small, this one is huge, so it gives us a change in direction, or change in volatility, or change in trend. So it is dropped and then picking it up again. So this is something you can understand from directional indicators. Now the red line here is the ADX. You can see the values. This is the ADS, average directional index. Blue line is the positive directional movement, DM plus, and orange line is the negative directional movement, or DM minus. So what happens is, when we see this gap, if the gap is high in some region, then we can see that this particular trend is prevalent. In this region, we see that yellow is below, blue is very much high, this gap is high, we can see there is an uptrend. Only looking at this region, not looking at prices at all, I can see that there is an uptrend here. There is a drop and then again it's going in uptrend. Though here I can see something reversing, right? Yellow is above, DM minus is above, DM plus is below. I can see something reversing here, and yes, I can see this touching the resistance, right? And slightly going down. Here again they are almost interchanging, they are almost like spiraling here. It's a flat zone, it's trading in neutral zone. So that's all information I have to gain from directional movements and average directional index.